Resource Watch is brought to you in association with Tebe Investment Corporation.
Hello and welcome. Commodity prices have been volatile over the past few months. Gold, oil, copper, these have been the biggest losers. So have we reached the end of the commodity super cycle? That's what we explore on Resource Watch this week. I'm Kukuletu Tsele. Let's kick off with the market wrap for this week.
South Africa lost out on 23 billion rand in coal export revenues last year. That's due to a drop in the commodities prices. Resources Minister Nyako Ramatlhodi said the extreme volatility in the coal price had a direct effect on company profits, employment and the country's fiscus. He also said South Africa needed to invest 100 billion rand to develop its coal resources. Platinum Group Metals miners in Zimbabwe reportedly have under 10 days to agree to build a refinery in the country or face a 15% mining levy on unbeneficiated ore or metal in concentrate. President Robert Mugabe's government wants to generate more margin from its mineral resources and bolster the fiscus. Meanwhile, Zambia's newly elected president, Edgar Lungu, has called for a swift resolution to a royalty dispute with foreign-owned miners, as well as to outstanding tax issues. Lungu says the ultimate aim is to protect jobs and keep mines profitable at the same time. This will come as a major relief to miners in Africa's second-largest copper-producing nation, who are currently struggling under the burden of falling global copper prices.
Volatility appears to be the only constant when it comes to commodity prices, especially of late. Gold has regained some of its shine since August 2014, whilst the prices of iron ore and copper have seen a downward revision from credit rating agency S&P. Well, to help us make sense of what could be the beginning of a bear market in commodities, we joined in studio by Frank Blackmore from KPMG, chief economist there. Good to have you with us today, Frank. Maybe if we can address that question, is this the beginning of a bear market in commodities?
I do think commodities are going to be in for a rough ride now, and I think the most important determining factor in that has been the growth revisions that we're seeing globally. We know at some point the US has to start growing, and I think that would be a positive for the commodities sector. But as we saw from the end of last year, prices have got a lot softer than they have been for a while, and that'll make this environment very tricky.
Before we get into the issues regarding growth and some of the recent revisions we've seen, maybe if you walk us through commodity super cycles.
Sure.
What needs to happen for them to occur, and why do they matter?
Well, a lot of economic variables occur in cycles, and the cycles occur because supply and demand are not always equally matched at every point in time. So generally what will happen, and what will be familiar to most of the people watching this show, would be the rise of China and the emerging markets created a strong demand for commodities. The problem with commodities is it takes a while for supply to catch up. So while demand is strong and supply is trying to catch up, you see an increase in prices above what we would call the long-term trend price. And then once supply catches up, it can even overshoot sometimes, and then you see a softening in the market. And I guess what makes the commodity super cycle super is both the variation in prices can be many multiples depending if one's in a trough or at a peak of a specific cycle, as well as the duration over which the cycle occurs. So it's normally between 20 and 30 years. And this current cycle we're in probably started going up here in the early 2000s. And now we're seeing a softening in that cycle. So that's basically what the super cycle is all about. And I think we are entering that phase where we're seeing some softening in commodity prices. And that could result in a recession in this market as well, depending on what happens to global growth.
A recession? That's a very big word that you've used there, especially because both the World Bank and the IMF have brought out downward revisions on global growth, in China that you alluded to earlier as well, not seeing fantastic growth that it recorded at least 7 years ago.
No, exactly right. And I think your main forecast is always going to be what's happening to growth in the world. Who needs these commodities? The word recession describes, as part of this wave-like cycle, a phase. So normally you get a boom phase followed by a bit of a slump where prices start going down, and then they enter a recession, and then they recover again, creating a complete cycle. So, but often they are correlated to or follow on from what is an economic recession or period of low growth economically. And following on your point, I think the world was waiting for signs of growth. And what we have seen is not necessarily those signs coming through. And therefore, a lot of markets have now been revised down, the IMF's growth revisions globally, as well as for South Africa. And that tells you growth is still some ways away, and therefore demand for commodities in particular is some ways away. So we can expect more softening of prices. One interesting commodity that tends to move counter-cyclically has been your gold, because when there's a lot of uncertainty in the market, we see money flowing into gold and out of other financial assets, equities and bonds, and I think that's what we're seeing now, a slight recovery on where we were in gold a few weeks ago.
So that safe haven title, again returning to the bullion?
Yes, exactly. So what tends to happen when people don't know where to put their money, they try and preserve the value of that money, and they think gold gives you that preservation of value. There's not much return from gold, we know that. All you have is the capital appreciation or sometimes depreciation in gold, so it's quite a risky investment, and possibly not one I would recommend, but it is a safe haven where people tend to run to when there isn't other sheer, obvious signs of growth around.
Tell us about oil, because that's the big story where we've seen it lose almost half of its value in the last couple of months.
Oh yes, oil. So if we go back to the commodity super cycle, during most of the 80s and 90s, oil was below $25 a barrel. And with the rise of China as an industrial power at the beginning of the 2000s, the noughties, we saw oil start climbing to a peak in 2008 of $147, or just over that. And as soon as the credit crisis hit, the markets knew that, well, that demand for oil at that price is going to subside, and prices dropped. And in fact, if the peak was reached in July of 2008, by December, oil prices were already below $50 a barrel, but recovered, and we've seen them around $80 to $100 since then. What happened at the end of last year was a lot of analysts waited for what OPEC's reaction would be, and speculated that if production wasn't cut by OPEC, prices must fall. And there's a parallel story that's happening here as well, which is, of course, the fracking industry in the US. That's come to prominence over the last 10 to 15 years, and it's created a lot more supply, so they're a lot more independent of Middle Eastern oil. And because of that excess supply, plus the fact that the Middle East are not cutting production, primarily in Middle East, some of Africa as well, of course, prices must fall, and that's what we're seeing now.
Just on that, the US fracking activities and shale gas, there does seem as though that's also put a significant amount of pressure on them, because companies like the likes of BHP Billiton coming out today saying that they're cutting back on some of their oil rigs. So pressure, it does seem, for some of the shale operations.
I think until there's more. So what generally happens when prices get soft, as they are doing now, mines immediately go into sort of a cost consolidation type mode, and any investment plans are shelved until they're in a period where they're certain prices will be firmer or be on an increasing trend. And what we see now is we're not quite sure where growth is going, or where oil is going, or how much supply. And so the market's trying to work out where oil should really be priced, given what the growth expectations are globally. And that's going to affect a lot of projects, not only in oil, but in oil in particular, because of the drop in the prices that we've seen in oil over the last few weeks.
Frank, in a perfect world, if the growth isn't coming from China and any other significant parts of the world, Africa is a resource-rich country. It's a continent rather that also needs a significant infrastructure development. Shouldn't the demand then be for those resources also be coming from Africa, which already has them under the ground?
Well, I think the demand is definitely there, and Africa started its renaissance. There's been a lot of investment in infrastructure, in capacity. The problem now is also the funding side. So lenders are not going to lend money for these projects given that prices of commodities are starting to fall. And I think that's the other side of the coin. The will is there, the demand is definitely there, but people are not going to take those bets now while growth is slowing down and while commodity prices are getting softer, specifically in the areas of commodities. Those projects are not going to go ahead. They're going to be shelved for other times.
Frank, thank you so much for your time today and sharing your insights with us. That's Frank Blackmore. He's from KPMG. And finally, here's a look at our gem of the week.
With the price of oil driving economic activity over the past few weeks, our gem of the week looks at how oil was formed and its most popular uses. Oil molecules form over thousands, if not millions of years. Crude oil is also called a fossil fuel because it's made up of the decaying material of formerly living things. It was formed from the remains of tiny sea plants and animals during the Permian period. Thanks to the action of heat and pressure, 250 million years later, they've been transformed into one of the world's most vital sources of energy. Petroleum is a smelly yellow to black liquid and is usually found in underground areas called reservoirs. Petroleum is refined and separated easily by distillation into a large number of consumer products. It's estimated that the world consumes about 90 million barrels a day. With the international oil price lower, South Africans are benefiting at the petrol pump. The retail price of 95 grade petrol dropped by 93 cents or 8.3% a litre.
Tell us how you feel about saving money for petrol.
Well, it's awesome. I'm sure everybody feels the same way. I mean, it can go towards other things, food, school fees, all that kind of thing. It all helps.
Fantastic. It's good. It's good for our pockets, good for our income, good for our expenditure actually. So feeling good. Hopefully it will be great if we can stay here.
Well, I feel very good about it. It's the petrol price going down helps us a lot. As a middle class, we get squeezed a lot. So anything that comes down really, really helps us. For me, I get an extra 200 Rand in my budget. I can only be happy.
Yeah, I think it's much more better for us, as I just said, and I think in terms of cash, yes, it is absolutely going well for us.
Yes, of course, but the problem is when the petrol price goes up, everything else goes up. When the petrol price comes down, nothing comes down in terms of groceries and what have you, and that's where concern is.
We're happy because obviously we have a few cars and there's a total saving of probably about 600-700 Rand, which is excellent. It's money that we can now divert to other expenses. So it's a good thing.
Well, that's it for this week's show, but do stay in touch. You can follow me on Twitter @Kukumfupi or use our hashtag #ResourceWatch. Until next time, it's goodbye for now.